presentation. Most years we get some reasonably big changes with what the IRS is doing. This year, I don't think they've changed too much. Maybe that's because they have kind of had some off and on year with shutdowns and things like that. But the point of this presentation is just to apprise everyone of the situations going on with the IRS, essentially the hot topics. What is the IRS looking at and how can you deal with it? Plus some general information about how to deal with it. And I'll go over the learning objectives in a second. We work for Eide Bailly. My name is Ben Peeler. I was formerly an IRS attorney for 8 years, handling litigation, bankruptcy, and summons enforcement collection issues for the IRS. Mike also worked for the IRS as well. He also worked in the exam, so he worked on the audit side before he worked in the Office of Chief Counsel. We're both attorneys by training, and I'm a CPA as well. So our learning objectives today are basically we want to give you a fundamental understanding of how the IRS is dealing with issues that are ongoing. And essentially, they've changed from a sort of, or more to a formula where they're focusing on campaigns, where they identify issues that they think are problematic, and then they make teams of agents and assign them to those. And so we'll go over some of what those campaigns are. Then we'll outline the process of an examination, sort of what it entails, what the options are during the examination, what leverage you have, and certain things you can do. Sometimes it feels like you're powerless, but there are some things that you can do to help in the IRS examination. We're always willing to answer questions about that later. So feel free to contact either of us if you have any issues with the IRS. Then we'll discuss the docketed and non-docketed appeals process. Sometimes this is very confusing to people. The IRS tends to push you one way or another, and they try to tell you that's the only way you can go, but really you control the decisions. And then we'll talk a little bit about the new partnership audit rules that although they've been in effect since the beginning of 2018, really this is the first time when you have to put statements on your return and make decisions. And then we'll talk a little bit about tax reform, what that means. Mostly what we've seen so far that could potentially be issues with the IRS. Now that could be 2 or 3 years down the road, but it's kind of what everybody's talking about.
So we like to show this slide every year, and Ben, you'll have to click through to get everything to pop up. But IRS audit activity has been dropping over the last few years. The most current statistics the IRS has released have been for fiscal year 2017. You can see that about 300,000 fewer tax returns were examined when you compare 2017 to 2015. So even in the area of partnerships, where the IRS had stated that they were going to allocate more resources and more people, that number of examinations in the partnership area is down as well. So individual returns, C Corps, S Corps, partnerships, everyone's seeing less and less audit activity. I think we're really seeing the effects here of reduced IRS headcount over the last, well, really approaching 5 to 10 years. They've had a couple of waves of hiring, but overall, people are leaving and they're unable to backfill those positions. So still a lot of adjustments being proposed. 29 billion of proposed tax adjustments through exam in fiscal year 2017. 11.5 billion of those were unagreed, meaning they went on to appeals. So
that's still a massive reduction from like fiscal year 2006, though.
Yeah,
so 44 billion of adjustments proposed.
If things keep declining at the same rate, I'd be surprised if we don't see it, down to 25 billion again, or maybe lower. We'll see what happens over the next couple of years. So we've got our first polling question here. So what percentage of tax returns were examined in IRS fiscal year 2017? Your options are A, 1.3%, B, 0.6%, C, 2.21%, or D, 0.5%. All right, so the right answer here was 0.5% across the board when looking at all tax returns. The numbers were different for each return type, but the overall is only 0.5%. So I think that
lately,
it's pretty low.
Yes, the lowest one. And
Yes, if you get audited by the IRS now, that just means that you've really won the audit lottery. So the tax gap, this is what the IRS estimates, or the Treasury Department estimates, between tax that's reported by taxpayers or captured through exam adjustments versus what's the actual amount of tax that would be due if everyone reported their tax returns correctly. So it's 264 billion on the individual side. This is information going back through 2008 through 2010, the last time they released these. 41 billion for corporations and 81 billion on employment taxes. So there's pretty
That's my
big discrepancy
favorite
there.
one. My favorite one is the employment tax and the self-employment tax, because that's when they were changing the tax law, they wanted to make it more difficult for S corps to claim that they had, that their income wasn't subject to self-employment tax or employment tax. And that's mostly where that comes from, is what they consider that abuse. So we promised we'd talk a little bit about the different areas that the IRS is focusing on. And I mean, these are all over in the news. They publish this list of campaigns, and they update it every so often. They haven't added anything really earth-shattering to it in the last 3 years, really. But the main focuses have been now every group. Before it was essentially SBSC was focusing on what we call micro captives, 831B micro captives. But now there's a campaign in LB&I and in SBSC for that. And then conservation easements, not just, so syndicated easements are what are transaction of interest or listed transaction, where you have to, both captives and easements, syndicated easements, you have to file a form 8886 letting the IRS know that you're involved in the transaction. So you have a high rate of audit for those specifically because the IRS knows you're in it. But then there's also problems with non-syndicated easements. And there was a recent case called Pine Mountain where the IRS won in a tax court case where the court agreed that it's very difficult to have moving envelopes of property, even if you have a charity that has a say in whether or not the house can be built in the scenic easement. And they decided that that wasn't in perpetuity. So those are a large focus for the IRS. Some of the others are in the LB&I campaigns, these 48C energy credits. I've really seen sort of more audits in several different energy credits than, that's just anecdotal information based on the clients we have and what gets audited, but that seems to be a little higher rate of audit on all of those, not just 48C. Related party transactions, hard to tell when you have that situation being picked up for audit, and they don't necessarily tell you, but they say that's a focus. The basket transactions, I think you would know those if you were involved in them, and there's specific notices that the IRS addresses there. One thing that came out was the Shea Holmes case. It's a few years old now, but there's still, the IRS takes a couple years to get around to making these campaigns happen. And that's this, the completed contract method and whether people are accounting for this appropriately. They're trying to increase the linkage in TEFRA cases, which are now, it's just going to go to the new partnership audit rules, but they would not be audited under that regime for at least another year. So there's still these TEFRA cases. They're trying to increase the linkages, which basically just tying different tiered partnerships together so they can do a true audit up and down, making sure everything's correct. S corporation losses, we've seen a lot more of these, and this seems to be a focus on all levels. And that,
A lot of shareholder loan examinations.
Yes,
Was an issue.
And the main problem there has been that there's no documentation, and if they do have a loan agreement, then they were not following it appropriately, like following the terms of the agreement. So those should be a focus of every accountant to make sure that their clients have those up to date and actually follow them. Then there's international audits. Of course, the OVDP program is going away, so there's less of those, but we're still seeing plenty of international audits for in those areas. A couple of more places that are not necessarily campaigns, but they're places where there is a high probability of audit. Still, research credits has a high probability of audit, and but that seems to be becoming, I guess, some of the people that provide the studies are becoming more conservative in their positions, or the IRS is backing off on them. But I think it's becoming agreed more often than going to court. Transfer pricing, always something that is a focus in any audit. If there is transfer pricing involved, it's usually a long, involved process of, documentation and the agent disagreeing with documentation. But production activity deduction, which goes away with the changes in the tax law, is still an area where the IRS is auditing, because they're always a couple years behind, and the law just changed last year. So, high net worth individuals, a lot of times, this with our clients that's just the reason they're getting audited, is because the IRS is still going through with this program and trying to audit everybody that has, more than 10 million in assets. So if you have that, you're eventually going to get audited at some point.
And if they have a lot of flow through businesses that they own as partnerships, S corps, all those would be looked at by the high net wealth or high net worth agent teams, or they send people out that just specialize in those and could get quite involved. We've had a few of those that have gone on for a while.
Yeah, when I was with the IRS, we had a few different billionaires that were being audited, and I would say those were huge, extensive audits that took. I mean, the IRS threw a lot of resources at it, and everybody has artwork, and so the art people got involved, and so they're pretty broad in scope.
Yeah, if they can find any adjustments there with the higher dollar amounts, it's they don't have to work as hard to find a large adjustment in those cases as they do for your run-of-the-mill small taxpayer.
Then the last one on this is valuation or study, and that's really just because those are the areas that are more gray, and so the IRS focuses on them when they audit. State and gift tax, there's always valuation issues, but sometimes there's transactional valuation issues. And when studies, that can be a research credit study, it can be a cost seg study, it can be all different kinds of things where, transfer pricing falls into that too.
Here's a few more samples of what the agents are looking at for these campaign examinations. So the campaigns don't replace a normal audit. They're what the IRS has called a tool for audit selection, meaning if you have one of these activities that it's the focus of a campaign, it may be the reason your return selected for examination, or if your return is already selected, then the agent can coordinate with teams of subject matter experts in the areas and get some help during the examination that way. There's about 50 LB&I campaigns now, including these ones shown on the screen here, and they allegedly will take some off the list as they go through and audit returns through the campaigns and see if there's any potential for adjustments. If the IRS finds that there's really nothing going on much in these areas, then they'll should close out the campaign and move on. But they do keep adding new ones periodically. So if you have clients in activities that are swept up in some of these campaigns, I'd say your chances of getting an audit are higher, even though the overall audit rate is so low. The more and more your clients are involved in activities that are in the focus of the IRS, then the chances go way up.
So just to hit some of these, I mean, we used to see a lot of self-directed IRA audits and I think that's because there was a big push for financial planners to put their clients into these self-directed IRAs, and a lot of them, they didn't outright violate some of the rules, but they didn't realize that they had to file other returns, like to report the unrelated business taxable income and things like that were a problem. The IP monetization transactions, that one is a little more amorphous. I mean, I haven't seen it very focused campaign. There's definitely one in Southern California for this. These are a lot of these, again, proposals where you sold off your intellectual property, or you're leasing it to another entity that you created and some of them use charitable contribution arms. Some of them just amortize them out. The IRS doesn't like them. I mean, there's still some people that disagree with that, but that's ongoing. And the reasonable salary. Usually, we see the S corp reasonable salary issues when it's a partnership of S corporations, such as in doctors and lawyers and accountants that are service-driven businesses. That the IRS focuses on those because there's case law that says that if it's based on the service you provide, it's going to be all subject to self-employment tax, regardless of the character at the partnership level when it hits your S corp and in recharacterization. It's a big one that lots of small companies use, but the IRS is focused mostly on those larger partnerships with more than 10 or 20 partners. So captive insurance, just to address this issue, I mean, this to me is a failing of the IRS side. I mean, there are abuses in this area, definitely, and the IRS has won cases recently. There are some of the worst cases, but the problem is that the court hasn't been able to find the bottom, and the IRS isn't interested in finding the bottom. So you get disparate treatment from taxpayer to taxpayer from the IRS, which is one of the main goals for the IRS is, treat all the taxpayers equally. But that I do not believe is happening. I mean, I've got several cases that IRS will select a particular client, and the case is really no different than any other case. But in my personal opinion, just to advance their careers or improve their position within the IRS, they'll push a case to trial, and another case that may even be worse, they'll settle. And so it's become a very difficult area because of, I think, inconsistent treatment across IRS levels. Exam treats them differently. After IRS won several cases, the examining agents have been more reasonable in settlement in exam, and then there's some that actually get settled in appeals now, when before they were just getting pushed right to tax court. But all those that are in tax court, it's very hard to obtain a settlement now, and that could be month to month. We don't know what's going to happen, so it's a very difficult area. Just some things I've note in here. They're not hard and fast rules there. They could change depending on the IRS personnel, but it's a very complex issue. And if you have a captive insurance company, remember you have to file the 8886, which lets them know that you're involved in the transaction. And this is only for the 831Bs, but if you have them, then there's a high risk of audit, and you should talk to a tax professional about it. Here's polling question number 2. When is Form 8886 due for captive insurance companies? So we have A, March 15th, 2019, or April 17th, 2019.
That one probably should say April 15th, 2019.
Yes. That comes from last year, right? When April 17th was the date. Then May 1st, 2019, when the return is filed, if on extension, or A or C.
So this is the third year that the IRS has required a disclosure on Form 8886 for 831B captives. And Ben, would you say that we've seen some, a lot, or no activity in exam based on these disclosure forms that we've helped clients file?
Definitely some. We have at least one that we know came from it, right?
Yep.
But I think that it's coming up soon, because I've heard rumors from the IRS side that some that have been selected were based on those filings.
I think there was a real deluge of paper filed 2 years ago, the first time these 8886 forms were due. They originally were due on May 1st, 2017, and then the filing requirement switched to attach it to your tax return when it's due. So the correct answer here was D, which is either A or C. So if you're filing timely by March 15th or April 15th, then an 8886 form should be attached to the return. If your return is on extension, you can attach it to your return and file it by the extended due date. If it's the first time filing an 8886 form for your client's captive, then a copy also needs to be sent to the Office of Tax Shelter Analysis, or OTSA, at the IRS. If you have any questions about preparing or filing a disclosure form for these, you can call us or email us afterwards. We do quite a few of these for our clients across the firm.
And typically the captive management company involved usually prepares one for the captive, but then one needs to be created for the the entity that took the deduction, plus any of the flow through owners. So it can be pretty onerous. We should note that the one that was audited and the 8886s were filed, the agent complained about what was on it, and it was with a company. We said, well, we think you should put more in your 8886, and they disagreed. And of course, now he's asserted that it wasn't valid, but we don't know if that's correct yet. But is to be seen.
Yeah, the penalties are pretty high for not making the disclosure that's required. It's $10,000 for an individual and $50,000 for a business.
So conservation easements, I mentioned that case, Pine Mountain, and so I mean this just kind of goes through the typical problems. Now the syndicated easements are, we get lots of clients that are approached with these. These are there's usually a promoter involved in a partnership, and they're selling you interest in the partnership. The IRS requires that you divulge your involvement in one of these, and on the 8886, if you're getting 2.5 times the value of the payment you put in. So if you put in $1, but you got a charitable contribution deduction of $2.50, then you need to report it. They're usually far larger than that. When I was with the IRS, we had a lot of these, and they're usually, I mean, the prospectus or the promotion sounds pretty good, but you have to be very careful because in a lot of cases they're ignoring a lot of case law, or they're not writing about it, so you understand the risk. We've had a lot of clients that were audited for these. Their personal return doesn't get audited, the partnership gets audited, and they really have no control and no say. Next thing you know, the deduction's been denied, and they may or may not have a penalty to deal with. So we've always indicated that it's important to watch out for these. The non-syndicated easements, it's usually, we talked about that case where the deed didn't have the appropriate language to make it in perpetuity. You have to be careful because what people did a few years ago has changed now with case law. So it's important to revisit these so that you know the risks. But those are very case by case.
Definitely need to have all of the required information attached on the return too for those conservation easement deductions.
Yes, and it's just good to make sure you review everything in the regulation and make sure it's on there, because it could be a small little thing missing that could ruin the whole thing. And I will say I'm also not happy with the IRS in this area, because when I was with the IRS, we would determine if the easement was, if we thought it was valued correctly. If we didn't think it was valued correctly, we'd let the taxpayer know. But if it was otherwise valid, even if there were technicalities, we'd point out the technicalities or ask them to fix the deed so the problem couldn't happen, and then still allow them to have their deduction. But now it seems to me they just push them all to court because they know they can win, so they do it. I don't think that's appropriate. I don't think it's the right conclusion when there's a slight error that's causing you to lose your entire deduction.
Right, or if it's a really situation where you have to cross all the T's and dot all the I's and make sure it's done correctly, otherwise the IRS will try to reject it for those technicalities.
Especially since the mistakes are usually the accountants, an attorney, the appraiser, or the land management company that took the easement. And it's usually the taxpayer had nothing to do with the mistake.
Exactly. So when we are dealing with an IRS audit or IRS examination, the way we handle it is we're always focused on building a file or building the IRS administrative file for this case. The administrative file is literally a file folder, a series of folders, box or boxes, as much as it takes for the IRS to put the whole package together on what happened during the audit. So if any information that's sent over to the IRS, any information that they gather on their own through third-party contacts, bank statements, invoices, whatever we've sent them all goes into the file, and that file is going to continue along with the process throughout different stages of the IRS. It'll start with the agent in exam. If the case goes to appeals, that whole file is going to get packaged up and shipped off to an appeals officer. And then if it goes from there to an office of chief counsel attorney, again, the whole file is going to get boxed up and shipped across the country to the next person. So we always want to get all the pertinent information in the file to help our case, even if we don't think that we have a realistic chance of changing the agent's mind or convincing the agent, because they don't really have any settlement authority at the exam level. The agent either is yes or no. There's no gray area or wiggle room. If we think we have a good chance of an appeals settlement, we want to make sure we have everything in the file, so that way when someone in appeals looks at it, we can say, well, we already had that in there. The agent didn't consider it or didn't understand it. We want everything to be in that file. So, when we're talking about a captive insurance examination, we want to make sure we get everything in the file to work on an appeals or chief counsel settlement, because we're almost certain that the agent's going to, not like the captive at the exam level and disallow things and try to move it on. So
Mhm.
we're always trying to get all of the subjective facts in there that we need to help build our case.
And that example there is kind of from the beginning of the captive audits, where if you're in a captive audit, you're building this file, and you got to remember, you don't want to build the file they want. You want to build the file you want, and they're collecting information in the captive case about intent, but you're trying to get all the information in there about you know whether qualified, whether it was risk distribution. So sometimes you have to make sure you provide information not just that's asked for by the agent, but what would be at issue later.
Right. And we're always trying to be the buffer between the IRS agents and our clients. Sometimes we're trying to craft the responses to limit penalty exposure, or even just minimize the adjustments that the agent can find. One thing that, when we're dealing with potential interviews of the taxpayer, which the agents always try to insist on, we've prepared in many cases some written responses to their IDRs, information document requests, trying to cover what they might be asking about during the interview, so that way when they sit down with the taxpayer and start asking them questions, we can interject with, well, that's already in our written responses. We've already responded to that. But we always have to make sure that our IDR responses are thorough while still responding to the questions that are asked or the documents that are asked for to the best of our ability, and framing it in the best way possible for our case file versus building the agent's case file for them towards an adjustment.
Well, that's why this conducting an interview one is such an important one, where we prefer to do it in writing. They want to do it verbally, and when we push it to writing, it allows us to control the responses, so that the agent can't make something out of a question that wasn't intended in the answer.
Right. And if it's an examination of a business that's run by more than one person, we always try to find out what the agent wants to ask about, so that way we can make sure we get the correct person for them that can answer the questions. It just is a waste of time for them to sit down with one person, the business owner, if there's a manager or someone else that handles the day-to-day operations that could answer the questions better. So this slide here is just a resource and some tips on how to handle an examination. Um, we just use this throughout all of our examinations. One thing that I'll mention down in the lower left area here, if there's a more complicated issue or something that needs more legal interpretation, then we always ask the agents to elevate that up to their chief counsel attorney advisors. Sometimes they'll push back and say, no, they don't need to or don't want to. But if it's a more significant legal issue, most revenue agents aren't attorneys. They haven't been trained in legal research or analysis, and they should be elevating those ones up. And sometimes you can shut down an audit issue once the chief counsel attorney tells them, yeah, they're right, you should drop this and move on.
And it's a real world example of this, as we had an agent that was attempting to tax the same income 3 different ways, and the partnership tax provisions are meant to make sure it captures it one way or another, but not 3 different ways. And we were going around and around for 6 months over this, and finally we begged and begged them. Some of them don't like us saying, you don't know what you're talking about, go to someone else. But we do it in a nice way, and they did elevate it. And next time we communicated with the agent, he said, "Oh, that's not an issue anymore," but it's been an issue for 6 months. So another one of my favorites is make sure that you're not volunteering information to the agent that could, privileged communication, or a communication that just because it might help your case, you got to make sure it's cleared with the taxpayer. Alternatives not considered by exam. This is just a common problem we have with the agents. And well, I don't know what I should invent a word for this, or phrase, right? Because in our world, there's a difference between the cases that have gone to court and have become rulings that everybody knows about and writes about in articles, and that the agents deal with and ends up in their audit guide. But again, the IRS picks and chooses the ones they like that end up as focus for the agent. There's a whole bunch of stuff that happens in the middle, and there's a whole bunch of cases that go to court that don't actually go to trial. They go to trial, but they might have a bench opinion, or sort of it's an informal opinion. I've even had a judge tell me, I'm not going to hear this. You guys go in a room and settle it, right? And so there's a whole bunch of that gray area even in the courts, so that what happens is the agents, they don't, they have to live by a stricter rule of evidence than really maybe even the court would. So when we talk about substantial compliance and things like that, that's where the agent doesn't realize that the courts could even allow something that, even though seemingly the law has allowed it, and there might be something that you didn't quite do, the court sometimes will allow, under substantial compliance, say that the deduction's allowed or what have you, if they did pretty much everything they were supposed to do and the intent of the law was fulfilled. So then, in evidence wise, the agents often seek things like, a good example is they'll deny a deduction because you didn't have a 1099. But if you go to court, the court doesn't care if there was a 1099 issue. That's a separate legal issue. There could be a penalty for that, but it doesn't determine whether or not you paid somebody for an expense. And so, but the agents will kind of create this standard that doesn't exist. And sometimes you have to navigate around those. And frequently down here, there's examples with the 274D. We usually just try to conform and create a log, but a lot of times the agents will reject documents because they didn't believe it was contemporaneous enough. I don't know what that means, but where we're recreated them and only they weren't created at the time. In court, that would be a completely valid log, right? Especially with someone testifying to it and how they created it. But the agents will sometimes reject it because they just don't feel that it's good enough, and there's no real legal basis for their decision. So then, go ahead, Mike.
Yeah, the Cohan rule comes out of the case Cohan v. Commissioner. It basically says that if there is sufficient evidence available that the court could use it to conclude that a deductible expense was paid or incurred, then you can get a deduction for it. So we used to use this even in exam, if you're a more reasonable IRS employee, to allow deductions for things like fuel. If it was a truck driver or somebody that we know was in a legitimate business. We know they were driving on a regular basis, but for whatever reason, they didn't have their receipts. Then if they had a logbook, a calendar, something to show where they were going and when, then we could estimate or recreate the deduction about, based on average fuel prices for the area that they were in and the time period. We can't just make it up out of nothing, say, well, they must have had some expense, right? Because they were operating a business. We need to have some evidence that we can use to get to the deduction.
We do have a lot of IRS, even IRS attorneys, though, that will refuse to review the documents for this kind of situation, right, Mike?
Yep.
Essentially force you to trial. But we've seen judges say, well, they're not going to go consider all the, where you might have a check copy, but you don't have an invoice, but you would have testimony about that check copy and who it was, why it was paid, which would be valid evidence, but the IRS won't hear that. And so sometimes the judge would force us in a room and say, no, you guys go through this. I'm not going through this.
Yeah, the judge doesn't want to hear 4 hours of testimony on what were those checks for if it's plainly obvious and it should be a settled issue.
Interestingly, one that I've seen recently that the agents have been using, which is sort of the opposite rule. It's the Wichita terminal case, where the court ruled that if you didn't produce the evidence, then it's implied that it would be against you. And I've seen agents use that in an exam. The problem with it is that's a court evidence rule, and it's not something in an exam. So sometimes they'll try to use that to their advantage, but it technically doesn't work.
So we're on to our third polling question here. This is one that comes up all the time, especially right now. So a taxpayer must sign a statute extension when a revenue agent requests one in order to go on to IRS appeals. True or false? We've actually seen a number of requests for statute extensions in the last few weeks. After the lengthy government shutdown back in January, once they came back online, everybody at the IRS got really nervous and twitchy about any case with a statute of limitations for assessment that was going to expire between now and September 30th. And they basically instructed their agents to ask for a statute extension in all those cases. So we had a lot of these come in, and the agents always say, you can't go to appeals unless you sign this statute extension. But it turns out that's actually false. You don't need to sign the statute extension in order to go to IRS appeals. There's two primary ways to go to appeals. You basically get there either right after the exam, when your agent issues a report that has a 30-day response due date, or called the 30-day letter, and you'll write a lengthy appeals protest letter and send it in that way. If you're going to go to 30-day appeals, then you do need to sign a statute extension if the statute would be expiring in the near future, meaning about 13 or 14 months in the future from the time appeals receives the case file. So if we were in exam now and our agent issued a 30-day letter and we responded by March 30th, we would need to have a statute open at least through May of 2020, because it's going to take the agent probably 30 days to close the case file and ship it on to appeals, and then they have to assign it to an appeals officer. By the time they get it, they'll probably need 13 or 14 months open on the statute.
And I don't think they call it AJAC anymore, but I don't know what else to call it. But everybody knows what we mean when we say AJAC.
Yeah, that was an appeals method, appeals, judicial approach, and culture, where the appeals officers were supposed to act as a judge, not really look at the evidence, new evidence themselves, or if there was new information brought up in the appeal, then they were supposed to send it back to the revenue agent to develop that stuff. Another option for going to appeals without having to sign a statute extension is what's called docketed appeals. What that means is we tell the agent that, no, we disagree with all the changes on your 30-day report here, or we're not going to sign a statute extension. They'll send it on for the issuance of a statutory notice of deficiency or a 90-day letter. You have 90 days to file a petition in United States Tax Court to challenge the proposed tax. So this tolls the statute of limitations from expiring, and once the petition's filed and an IRS attorney responds to it, then the case file goes to IRS appeals. So we're basically in the same place we would have been from 30-day appeals, but now we haven't had to sign a statute of limitations extension, and we're still going to IRS appeals.
Sometimes this can be the best way to do it when you're dealing with an unreasonable agent that just sort of abuses the ability to obtain the statute extension and sit on your case and sort of waste everybody's time.
Right.
So then there's IRS appeals, but sometimes appeals it just doesn't work out. Sometimes we tend to find that the IRS, and this is not just from our experience outside the IRS, but inside the IRS, that it's a people bureaucracy. Each person is different, and they have a lot of discretion and a lot of autonomy, and you can't necessarily control. And so sometimes there's just nobody telling them they can't do what they do. Some of them are just heavy-handed. I had an appeals hearing yesterday where the appeals officer did not let us say 2 words, and they're telling us that their legal interpretation is it's going to win the day. In that case, we can't go to chief counsel, and we're stuck in appeals, and they're the final arbiter of the rule. But they're just not listening to us. So fortunately, if you go the docketed appeals route, or even if you go the 30-day appeals, but eventually don't agree with the appeals officer, you have one more person you can talk to. Sometimes that's just what we do in the IRS, is try to hunt for a reasonable person who will actually listen or read the arguments. And that's the Office of Chief Counsel. Both Mike and I worked in the Office of Chief Counsel, and so there are a lot of IRS attorneys that will take their job seriously and kind of try to find a way to resolve the problem the right way. Not all of them, but if you can't settle in appeals, you could end up in Office of Chief Counsel. This has become more of a problem. I think we get a lot of attorneys now saying they're not going to look at documents, and they're not going to do this, they're not going to do that, and they want to send it back to the agent. But they can and have plenty of control to review and resolve the case. Then they will review the admin file, like we said, as put together by the RA, and you want to make sure you get all of your documents in there too. Usually we have provided an appeals memo, or we'll have provided a protest or something in appeals, but this appeals memo is what the appeals officer writes when they've decided, disagreed with you, so that IRS attorneys will get that too. Kind of goes over the strengths and weaknesses. I like to get a copy of that if I'm going to the Office of Chief to IRS attorney, so that I can see if they were off base on something, and then deal with that directly. Because you'll be surprised, when I was in the Office of Chief Counsel, sometimes I just had, and I met with the taxpayer, I had an hour or so to review the entire file before the meeting, and there was just no way you could do much else with it in that amount of time. You might have more time, but a lot of times that's all the time you had, considering all the cases you had. And so you want to make sure that there's all the documents are in there, but there's also an abbreviated description. You usually have a conference. You can submit more evidence, and it's a lot more. They'll oftentimes now try to send it back to the agent to consider some of that evidence, but they can just consider it. And most of the time, if they're being even more unreasonable, you can say, hey, why don't you just give me what the appeals officer was going to give me?
Yeah, it's interesting that you said you dealt with a really unreasonable appeals officer yesterday, because I had a call with one that I thought was very reasonable. He just got assigned to this case. He wanted to set an initial call just to discuss his preliminary thoughts on the case after looking through the admin file. And I asked him, hey, did this evidence get in the file that the CPA sent in, pretty late in the process? It was after the notice of deficiency was issued. And he said, no, I didn't see that in there at all. Okay, all right, well, we're going to send that again, so you have it to consider. In that case, it was a lot of photos of assets that were repaired, and we took a deduction that was disallowed. So in that case, with a really reasonable appeals officer, it seems like we're going to be on track for a settlement and we haven't even really discussed the merits of any issues yet. So if you get somebody who's reasonable, then things just go a lot smoother. And that's definitely true in the area of penalty abatements. We file a lot of penalty abatements with the IRS because they're generally pretty successful, but it doesn't always work on the first try. So if we're asking for a first-time abatement, if that's available for certain tax or for certain penalty code sections, then if the taxpayer qualifies, the IRS will always grant it. You can get those over the phone just by calling in. If you need to go on to a reasonable cause argument because they don't qualify for the first-time abatement, then that has to be in writing. And many times, I'd say 9 out of 10 reasonable cause arguments get rejected by the IRS, and then we have the opportunity to appeal, and we go on to appeals where we win a lot of the time, most of the time. So it's particularly frustrating when you have a good reasonable cause scenario that you've written up, you send in, the IRS rejects it, you file for an appeal, and then the IRS just approves it on appeal without even having to go to a hearing or anything like that. So they seem to be rejecting a lot of reasonable cause arguments, but then allowing them on appeal. So here's a few statistics on individual and estate and trust accuracy penalties. The IRS last year assessed 557,000 penalties for $1 billion. Of those, 45,000 were abated for over 200 million. And on civil penalties total, out of the 26 billion that were assessed, a lot were successfully abated. $12.5 billion were abated. So this doesn't show the number that were asked to be abated. I'd say that if you file a penalty abatement, your chances are better than 50% most of the time that it's going to be successful. So we always recommend, unless the dollar amount is really de minimis and it wouldn't be worth most people's time to put up an argument, if there's a substantial penalty dollar amount, then it's always worthwhile to at least attempt a penalty abatement. On to polling question number 4. The first-time abatement requires a written letter to the IRS. True or false? And while you're responding to that one, I'm going to go ahead and move on to the next topic we've got for discussion, as we're starting to run a little short on time. So passport revocations and denials. This is a new thing that the State Department's doing. If your taxpayer, your client owes more than $51,000 in back taxes, interest, or penalties, the Treasury Department will certify that taxpayer's name on a list. They'll send it to the State Department, and then if your client tries to apply for a new passport or a passport renewal, then that can be denied. We've actually seen this for a few of our clients now, where they've tried to send in a passport renewal. They owed more than $51,000, and the State Department says, your renewal's rejected. If you get off the certified list from the Treasury Department, then you can reapply. So the answer to our question, first-time abatement, that's false. Do not need to send in a written letter for that. You can just call in and get that one over the phone. You can also get it on a letter.
Apparently we didn't do a good job of communicating that one. So now we're on the new partnership audit rules. So these just came into effect January 1st, 2018. And essentially it's the IRS got sick of the TEFRA way of doing things, which I agree was a very complicated, messy process, especially for the IRS. I had a lot of TEFRA cases when I was with the IRS and probably spent more time trying to figure out if we did things right and linked things and sent the right notices and everything than we actually worked on a substantive case. We'll see if this really affects that or helps that, but the process pushes a lot of the work to the taxpayer. What you really just remember from this, unless you want to ask a question about it or call us, we do a whole other presentation that has this information in it, is that a lot of this needs to be done on this return for the 2018 tax year. There's going to be some information that you need to put on that return. There's a special form. It's just a change to form that the IRS already had for selecting the TMP. Now you got to select a personal representative. We've had a lot of issues come up. There can be more people can be a partnership representative, and can be an entity and different things like that. But the form is actually requiring people to put an individual at that entity. So it's kind of the same thing that a tax manager partner had to do, and include their social security number so that IRS could contact them. Another thing you got to consider is that you may have to change your partnership agreement to include this information if you haven't already, something that should be done. But this slide kind of details all the things that would matter to you. This is generally, people have to choose whether or not they're going to opt out on this return, and these are just some of the options you can have. I think the general consensus is most people are going to try to opt out if they possibly can opt out. So
And if you opt out of the new partnership audit rules, then you're not going back to TEFRA because that's gone, right? You'd be in the pre-TEFRA rules.
Yes, so and if you can opt out, then it's essentially you're small enough or in a situation where the IRS could, handle it. There's with the few partners that you have and how to deal with it. But some people have asked questions like whether they should opt in early because they wanted to do something where they didn't want to go through the old AAR process, or they didn't want to go through the amending every partner's return for an adjustment. They'd rather have the partnership pay the tax. Those are all things that people have gone and considered, but I think generally people have, still the consensus that people want to opt out when they can.
So the corporate tax rate, I'm sure everyone's quite familiar with the changes here. Why don't we skip ahead to the 199A? If you want to talk about that, Ben, we've got about 5 minutes left.
Yeah, so there's a whole other presentation that our firm puts on about this. This gets very complicated in and of itself, but this is just generally a description of the 199 Cap A and how it works. Essentially, get this 20% deduction if you qualify. You have to have qualified business income, and there's some exceptions. There's limitations. It's not just a 20% deduction that you get on all that income. It's limited to 50% of the W-2 wages, or the sum of, or the lesser of these two, and the sum of 25% of the W-2 wages, or they added something that helps the sort of real estate businesses, where if it's 2.5% of the taxpayer's unadjusted basis in qualified property. So we're not going to go through this. We don't have much time, but I will note that you can still qualify. Like, people that get wages typically don't qualify. One of the other big things that people don't know is if you have guaranteed partner payments, that's akin to a wage. You're also not going to qualify for this. But if you're below these income thresholds, you still could qualify, but not if you have wages or guaranteed payments.
Right. So if you're in a specified service, trade, or business, and you're below the income thresholds, then you can still qualify for the deduction, right? It's when you get over the cap, then if you're in the specialized service, trade, or business, like a doctor, accountant, attorney, then you start to lose the deduction, right?
Yeah, and so essentially, before we get to this question, so people that normally, it was very easy for when you're doing a partnership return to just choose guaranteed partner payments. Since you were a service-related entity, everything was going to be subject to self-employment tax anyway. That a lot of people, that's what they characterize the income as. But now you're going to have to go through a much more difficult process of determining whether really those are guaranteed partner payments, because it would automatically exclude it from this deduction, and some of the partners might be able to obtain it and wouldn't want you to do that. So polling question number 5, guaranteed partner payments are qualified business income for purposes of 199 Cap A. So while you guys are answering that, I'll move on to the next. Oh, it's okay if I take it back there, Amy. So now this is just generally tax law changes and some of the things that have come out of 199 Cap A. Mike, I guess you can kind of address the first part there.
Yeah, there's definitely some changes that the IRS is going to have to do here. I mean, they've obviously allocated a lot of personnel to getting ready for filing season, but they're going to have to reconfigure their staff in terms of who's working in what areas, what are they looking at, you know, something that's brand new like a 199 cap A deduction that there's nowhere on the 2018 tax return form to show how you computed it. I would think that the IRS is going to have to look at that, you know, in any return that takes a deduction. So they're definitely going to have to reallocate their resources, which are dwindling every year with the budget reductions and staff headcount dropping.
So the last point we'll make is sort of some of the hot topics in this area that have developed, and everybody wonders, well, what is the IRS going to do down the line? Because even though they've suggested things in the final regulations, still some not games but different positions people can take, and then the IRS will certainly address them or issue more guidance. Obviously, since there's the wage limitation, limits the amount of the deduction, people are going to sometimes be motivated to increase the wages, and then reasonable compensation issues could come up there in outside of the C corp realm and on the opposite of the S corp realm. So there's that area. Then there's already things where the IRS already said they didn't like this crack and pack plan that people had said they were going to do, because you could have a business that had a lot of wages and one that didn't, and you wanted to align their business income and the wage limitation together. So whether or not you could aggregate businesses, or it might have one business might have income that doesn't qualify and you want to break it apart. So there's all these different plans out there. Some of them say, well, you can also put some in a C corp and put some in a flow through and sort of reinvest through it, but be all one business. There are several different transactions that are being proposed. One, though, that I think is a hot topic is that this definition of a trade or business. The IRS said, well, it's not going to be based on, some people wanted it to be based on the passive activity rules, but they said, no, it's going to be based on Section 162, which could be kind of a broad definition. So a lot of real estate people are wondering whether, and people are saying that the triple net lease situations don't qualify because the IRS indicated that they didn't believe it did. So that's an area that's a hot topic. We have some examples, but we won't go through them because we're out of time. If I can get the slides to advance, but you're glad to go back through them and ask questions. They just kind of explain the difference, kind of how the limitations work. So last, Mike, maybe you can run through these real quick, who benefits and who doesn't.
So generally, who's benefiting from this is rental real estate businesses, engineers and architects, because they were originally on the personal service business or specified service trader business list and then removed, and trusts that own a business interest. They would all be benefiting from the 199A deduction. Who does it hurt or doesn't help? On the next slide, we've got partnerships who pay guaranteed payments rather than wages. Any of those personal service businesses and business owners with income in a certain range is basically, if you hit income levels that are over the cap here, then you don't get to take any further advantage of the deduction.
There definitely will be a lot of people changing the guaranteed partner payments in the
Yeah, it's going to require changes to their partnership agreements and a lot of changes.
And that could come up in a partnership. Then there's reasonable compensation issues that can come up in the S corp. We had usually artificially low wages before. Now they may raise them up, and the IRS might not like the drastic changes. So there could be audits that stem from that.
We've got a question here on our last polling question. It was, what was the answer? We forgot to give that. So guaranteed partner payments are qualified business income for purposes of 199A. That is false. They are not included in the QBI computation.
Yes. So then there's just a few things. This last slide here is just about the changes to individual taxes. A lot of people are, grasping with how that really works, especially with the state and local tax limitation, and in states where they have, hefty taxes, state taxes there, it's become a problem, or even a political issue. state tax. Now that has definitely that changed, but it's a lot of it's sunsetting. So it's put the whole state and gift tax world in a that like in the old days before 2010, where you had to kind of figure out a way to consider all options if the law changes back the way it was or decreases. So that's all our slides, and we're certainly open to answer any questions. Sorry we went over a little bit.
Awesome. I don't see any questions right now, but if you guys do have one, feel free to use the Q&A box located on the menu bar, or you can use the chat feature.
I know we ran through a lot of those things, but we get a lot of questions from people handling examinations and kind of why the IRS is doing something. I'd just like to point out this, you know, it is a people business. You have to learn to read the agents themselves and understand, you know, where they're coming from, and you can't always just assume that 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 they're the ones that you'll need to resolve everything with. More often than not, if they disagree, they're not going to change their mind, and we tend to advise people that, you know, take a chance in appeals. One thing we've used a lot more that we didn't have time to address in there was the early referral appeals process, which has worked well for us in most cases, where we've said, you know, it was usually it's an issue where it's just a legal dispute and there's some facts that the appeals could consider. You can get to appeals much faster, and they sort of act, it's kind of like the old mediation process with IRS appeals, where they first hear you both out, and then they'll take one of you off the phone and talk to you, and then they try to come get you to a resolution. The reason why that's great is because a lot of times IRS the agents will tell you they're not allowed to settle the issue. They don't have authority. But if you go through that process, you can settle because you're using the appeals officer's settlement authority. So something I would mention there. So I don't see any questions.
I don't either. So I think we're good. If you guys do have any questions at all, please feel free to reach out to our presenters today. Awesome. Well, if you guys are good, I think we can go ahead and end it. Thank you guys so much.
Great. Thanks for attending, everyone.